Hi, good day. So welcome back to another section with us on accounting discussion. So today we are going to continue with our discussion on the accounting equation that we started in our previous lesson or in our previous video. So we are going to continue from there and then establish the rules for recording of business transactions in the books of accounts, as we learned in our previous video where we learned about the accounting equation that help us to establish a principle called the golden rule or the double entry principle for recording. So that's where we're going to continue our discussion from, so that we'll journey to know more principle when it comes to recording of business transactions. So that's what we're going to do for today. So just want to make sure that you stay tuned and then you watch us as we take you through the recording principles. So in our previous lesson, we generally established that when it comes to that of the recording, we build up, a principle, a formula, which says that we have accounting plus expenses should be equal to that of our capital plus revenue plus liability. This is where we establish one of the key principles, and we said that this is an accounting equation which explains the issue about the statement of the financial position, also called the balance sheet. That at any time our resource provision is being managed and controlled by the management or the business entity concept. We discussed some of these things better. So once we're able to establish this in our previous lesson, we said that if I should indicate what a vertical and horizontal line in this, then here all the items on the left hand side, which is the assets and then the expenses, will have what we call what. So the left hand side will have what we call a debit. And all items on the right hand side that you can see here will also have a credit. So it is this that established the double entry principle. So from the accounting equation, double entry principle, so we have it here, double entry in accounting. That's what we are looking at for today. So as we said, when it comes to the double entry principle, the rule is that when it comes to business transaction or recording of business transaction, it must affect the books twice. That means you must have a debit and a corresponding credit, right? In terms of the entry. So generally, when we say double entry, as I said, the books must be affected twice. Must have a debit balance and then a corresponding credit balance, or vice versa. That means a credit balance and a debit balance. This concept is also being supported, or this principle is being supported by the duality concept, which says that at least when it comes to recording, the books must be affected twice. So that is the rule. Others call it the golden rule of accounting. Others also call it the double entry principle, or others also call it the basis or the masterpiece for recording of business transactions. So let's take note of that. So from this table, we can clearly see that we have assets and expenses on the left hand side, and then we have on the right hand side we have capital revenue, and then that of liability also on the right hand side, which is also called a credit. And this established what we call the double entry principle. So having to know the principle that helps in the recording of transactions in the books of account, then what are the books that we're supposed to use in the recording of business transactions? So that will lead us into what we call the book called ledger. So when it comes to recording of business transaction, there is a book that we use to record all business transactions that have a monetary character, and we call that as a ledger. We call that as a ledger. So what then is a ledger? If somebody may ask, when we say ledger in generic term, a ledger is actually a book which summarizes all transactions. A ledger is a book which summarizes all transactions generally. That's what we call a ledger. So in a more accounting term, we say that ledger is the principal book of account which gives a summary of all transactions that's occurred over a period of time. Others may call it the principal book of an account. The principal book of accounts. Or others may also call it the final resting place. The final resting place of transactions. Others may also call it what the final resting place of a transaction or the principal book of what accounts. Once you heard of a ledger, we are talking about what? The account. We are talking about the account. So that is generally what a ledger is. So when I have something like this, let's say I have this, or let me present it here. I have a horizontal and a vertical line meeting. This is what we call the T account. The T word account. It's also called the ledger word account. Others also refer to this as well, the horizontal word account. The horizontal word account. So it is when we are saying ledger account, this is what we mean, the T account. So we are saying that all items that comes into the business must have what? A debit balance coming in, incoming items. And all item that goes out must also have what? A credit balance. We'll look at some of these issues better as we move along. Just have to stay tuned as we move through the discussion. So once we know the book that we used to record in the books of the account, then somebody may ask, what are the various forms of transactions that we can record in this book of account? And that will lead us into the various types of ledgers that takes into account the recording of business transactions that occur throughout the business setting. Because the transactions is not uniformed, right? We have different form of transaction coming up. So you may have various transactions, but we must also know the books that record different transactions that comes into the business. And that will lead us for us to discuss the various types of ledgers that we have in the books of the account. So what are the various types of ledgers that we have? So under the various types of ledgers, we have one. We have the first one, we call it what? The general ledger. The general ledger. Two, we have the sales ledger. We have the sales ledger. Then three, we have what? The purchase what? The purchase ledger. Okay. We have the purchase ledger. Then four, we have the private or owner ledger. And then lastly, we have for the cash book. We have the cash book as also what? A ledger. We are going to walk ourselves through with these various ledgers. So based on your school of thought, you may have these 5 levels of or types of ledgers that may exist in the books of accounts. Others might even get 6. Depending on the school of thought, you may have these ledgers coming up. So when we say a general, what is a general ledger? We have been saying that ledger is actually what? An account. When we say ledger is an account, that gives a summary of all the transactions that occurred in the business. So when we say a general ledger, what is a general ledger? So general ledger in simple terms has to do with a ledger which deal with the recording of transactions which cannot be recorded in a sales ledger, which cannot be recorded in a purchase ledger, neither the private ledger or the cash book. Any transactions, any other transactions which we cannot record in the below ledgers we have listed here will be taken care of by the general ledger. So general ledger record all transactions which cannot be recorded in the other ledgers that we have listed here. So when it comes to general ledger, it records 2 items. These items are what we call, we have real and then what? Nominal. General ledger records item of real and then nominal what? Transaction or nominal what? Yeah, transactions or items. So what is a real what? Items or real transactions or real accounts? Because at any time we are recording the transaction, it will lead us to get what? An account. So any transaction that have a relation with what? Real items, we will call it what? A real account. To be factored in the real account. So we have real and then nominal. So when we say a real items or a real account, it's an account that takes care of what? Transactions of tangible in nature. Take note. So issues like the non-current assets will be factored in the real account. For non-current assets like, property, plants, and equipment, these are what? Assets. So tangible assets will be taken care of in the real world account. So real account records items of that are tangible in nature, right? So once you hear of PPE, then it must be factored in the real world account. But when we talk about the nominal ledger, the nominal account, this account deals with recording of what? Transactions that have what? A short-term what? effect, that has a short-term effect within what? The business period, which is what? Within 12 months. So nominal account records items like what? Revenue, and then what? Expenditure. Revenue and then expenses. So let me put expenses for you. Revenue and the expenses, which occur within what? A year. That means its effect will take place within what? Just 12 months. This is what we call what? The nominal one. So all transactions or any other transaction that will be factored in as part of revenue expenses item that occurred or whose effect lasts within a year will be taken care of by the nominal ledger, the nominal account in that particular way. So we may have what? Income. We may have discount received, right? We may have discount received. We may have rent. We may have salaries. We may have, all form of expenses and revenue that you can think of will be factored in the nominal ledger. Will be factored in the nominal ledger. As I said, whose effect will be within what? The next 12 months. That means within what? A year will be recorded in the nominal ledger. So let's take note of that. So that is the issue about the general ledger. It records all transactions which we cannot record in the listed ledgers below it. So that is the issue about what? The general ledger. Then we come to the sales ledger. What is a sales ledger? When we say sales ledger records items of persons. Items of what? Persons. Or personal what? Items. Right? And most cases, sales ledger will deal with what? The issue about debtors. Debtors or trade and other receivables. But let me put it in generic terms. Let's say trade receivables. So that in future, we don't conflict ourselves with anything. So whether debtors or what? Trade receivables. So personal item, persons. Right? So here our customers in with the business that we supply goods to them or we sell goods to them on credit and later they will come back and pay. They are referred to as debtors or trade receivables. So we intend to receive what? Our payment from them in the later date. That's why we call them trade receivables or what? Debtors. And it's out of this ledger or account that takes care of what? These what? So all transactions that has a reflection with debtors or trade receivables should be captured or recorded in the sales what? Ledger. And the opposite is true. If it's not debtors, and we are talking about what? We are talking about creditors. We are talking about creditors or trade payables. Trade payables. So all transactions which will come under creditors or trade payables will be factored in the purchase what? Ledger. So that is the idea when it comes to the purchase ledger. And then the private ledger or the owner ledger, they should tell you or give a clue about which type of transaction will be recorded in this account. Here, we are recording all information about what? The owner. The owner. All information about the owner should be captured. So owner's what? Information. That have what? The business what? Effect. In terms of what? Monetary value. So here, issues about drawings, issues about capital introduced, issues about dividend received, issues about all these things will be factored in the private or the owner ledger account. So that is the idea about what? The private or the owner ledger. It records all items about what? Let's say those who provided our capital, investors or capital providers, their drawings, any profit that they receive, dividend, those kind of issues will be factored in the private or the owner ledger. And when it comes to the cash book is also a type of ledger which records items of what? Payment and receipt. It records items of payment and receipt in terms of what? Cash and check only. Cash and check what? Only. So that is the issue about what? Cash book. It's also a ledger which records items of what? Payment and receipt in terms of what? Cash and check only. So let's take note of that. So that is the idea about the cash book issue. So payment and receipt in terms of what? Cash and check only will be captured in the cash book. But note that cash book has a dual purpose. It serves as for a ledger at the same time, serves as a day book. When we get to the day books of account, the books that we use in the account, you understand, that we use in our day-to-day record, even before we chip in the ledger, we'll understand it. We call them the day books or the prime books of account. Cash is also part of the prime books or the day books of account. There are those books in which transactions are first what recorded. Firstly, what recorded. We'll get into it when we are through with it. So let's take note of that. So cash book serve as what? A ledger at the same time, or the day book. You just want to keep that for the future. So that is the idea about the various types of ledgers in which we can record business transactions in it. So let's take note of that. So having to elaborate more on this, we then have to come back to our double entry principle, where we have established fundamentally using the basis of the accounting equation that we just learned. So what is the idea that we are trying to say here? When it comes to double entry, as we have already been indicating, it is a principle that allows us to record transactions in the books of the account. And it says that to every account, there should be a debit balance and a corresponding credit entry corresponding credit entry in that way. So we have a debit balance and a credit balance generally, or credit entry, debit entry, and then a credit entry. So what is the idea here? Now we are able to indicate that all the assets and expense on the left will be debited, all things being equal, and then all items on what? Credit, which is capital revenue liability supposed to be credited, all things being equal. So the idea we are trying to build on when it comes to double entry has to do with, okay, if that is the case, then what are the items that comes under assets? What are the items that comes under expenses on the debit side? So on the assets, we can think of what? Current assets and then the non-current assets. So all items that falls under the current asset, like stock, okay, like what? Trade receivables or debtors. Okay, then we may have cash and its equivalent, cash and equivalent. Then we may have prepaid. All these things, all things being equal, will have what? A debit balance. In terms of the balance, we're going to have a debit balance. Or in terms of the entry, going to reflect at the left-hand side of this account. As we have already indicated, this is what we call the T account. The T account. So let's take note of that. So all items and the current assets that falls under the assets will have a debit balance. Likewise, the non-current assets, where we have what? The issue about PPE, property, plant, and equipment, right? All these things also fall under what? The asset group, and that will also have a debit balance, right? So here we can think of, land and building. Here we can think of equipment. We can think of a lot. All the items that falls under property, plant, and equipment will also have a debit balance. So that is one aspect you're supposed to understand. And all other issues on expenses, all expenses, irrespective of the effect and the duration in the business, must also have a debit balance. So expenses like rent, right? What again? We can think of, capital investment. When we make capital investment, which results in an expenditure, it's also part of it. A long-term effect expenditure will also have a debit balance. So all other expenses should also have a debit balance. That is one aspect when it comes to the assets and expense being on the debit side. So that means that all these items will be or will have a debit balance when it comes to recording, right? So let's take note of that. When we come to the credit aspect, we have capital. So issues of owners, right? Like owner introducing capital introduce, any additional capital supplied, right? Additional capital supplied. All these things will be factored in as part of a credit. We'll credit the capital account, which represent the owner, right? So let's take note of that. And any other information that will fall under the capital will also have a credit balance. How about revenue? Issue about revenue. So revenue, all form of revenue, income, right? Sales, sales, dividend. I say dividend, I mean discount received, all form part of revenue, short-term revenue. So all forms of revenue, whether it's coming from the ordinary course of the business or it's not coming from the ordinary course of the business, whether it's coming from the core activity of the business, which mostly has to do with trading of what goods. It's a service to then service, which an ordinary what revenue may receive, it will fall under what I mean a credit balance. Or if it is a non-core or not from the ordinary course of the business, like what I mean investment income that you receive, I mean discount received, those things are not from what I mean the ordinary course of the business. That one is also part of the revenue. Supposed to have what a credit what balance. And then liability, all forms of liability, whether a current liability or a non-current what liability, all forms of it should also have what a credit balance. So that is the idea we try to build when it comes to double entry. So you are saying that assets, all forms of items that will come under the asset must have what a debit balance. That means debit balance is supposed to be on the left hand side of the T account, this account that you can see here. So that is the idea that we need to understand when it comes to, I mean, the issue about what? The double entry. So that means that all items that fall under the asset expense supposed to have what a debit balance. By debit balance, supposed to record it on the left-hand side of the T account, this side. And all items that falls under the capital, revenue, and then the liability supposed to be recorded at the right-hand side of the T account or on the right-hand side of the T account, which is what? To be credited. So to be credited means supposed to be recorded on the right-hand side of what? This T account. So that is the first part of what? The recording. One principle when it comes to what? The recording aspect of what? The business transaction. Another aspect has to do with in terms of it what? Incoming and what? Outgoing. Because when we started this double entry, I did make mention of the fact that there's also an aspect of what the movement of the items of the transaction. That will also tell us the nature of whether it's going to be entered at the debit side or at the credit side. So that's where we are heading towards to. So in terms of what the movement, so we'll have what? Let's say incoming. We'll have incoming and we'll have what? Outgoing. Outgoing. All right. So we'll have incoming and outgoing. This is what happens in here in terms of debit and then credit. So if we have an item that falls under the assets and then expenses. So we are saying that in general terms, we are saying that all items that falls under the what? Assets and expenses. If it's an incoming item, it's supposed to be what? Debited. So this is what we are saying. That one, if it is assets and expenses, I'm shortening it for the purpose of what? I mean, explain so that I will explain it on top of my voice. So if it's for the purpose of what? Assets and then expenses. All items that falls under the assets and expenses, if it's an incoming item, it's supposed to be what? Debited. Supposed to be debited. Under the assets, supposed to be debited. What are incoming items of assets and then expenses? Let me give an example. When we say an incoming item, for instance, let's say the business what? Bought what? A new vehicle. A new vehicle. What is happening here is that they bought a new vehicle with what? Let's say cash, right? Physical cash. They bought a new vehicle with cash. That means that the vehicle that has been bought, the vehicle is coming into the business to help in the running of what? The business. So that means that the vehicle is an incoming item, and that vehicle is also an asset. So it will fall under the asset group, and then we are saying that all incoming items supposed to be what? Debited. Right? Supposed to be debited. So all incoming item in this case supposed to be debited. So the vehicle which we have bought with cash will come into the asset group as part of what? A debit what? Entry. So that is one aspect here. How about the expenses? Let's say we have what? I mean, we realize that for a particular period, the market for our product has increased so much, and we need to what? Increase our production output so that we can capture or get more of what profit from the market, right? So that we can actually obtain high profits from the market because of the maybe the taste and preference of our product. And on that wise, we have went in to get what I mean. We want to get in, like say, space that we can keep this additional what product we produce. That we can keep this additional product we produced. So what is happening here is that we went in to pay for that item or that space. We went to pay for that space. At that point, when we pay for that space, it means that at that point, that space is now part of our asset that we can use to what? To keep our stocks within the business line. That means that at that point, that space is an incoming item because it has become part of our assets, right? Which occurred as a result of an expense or rent. When you rent an item, it's an expense, right? So that means that at that point, that space is coming as part of our warehouse we're going to use to keep what? Our inventory, or we use to keep our inventory. So that is the idea here. So that means that that space is also an incoming item under the expenses and supposed to be debited. So that is the idea when it comes to the incoming items with respect to assets and then expenses. So all incoming items with respect to assets and expenses supposed to have what? A debit what? Balance. Supposed to have a debit balance. So let's take note of that. Let's take note of that. How about capital? So two. Capital, revenue, and then liability with respect to incoming item. So we are saying that all incoming items that falls under capital, revenue, and the liability supposed to have what? A credit balance. So here we are talking about a credit balance or a credit what? Entry. A credit what? Entry. What do we mean by an incoming item with respect to what? A capital. An incoming item with respect to capital can be, for example, let's say the owner has actually what? Come out with one additional capital or additional cash to be used to run the business. Since the owner that is giving that amount is coming from the owner, and in our discussion on ledgers, we said that we have a ledger called the owner ledger or the private ledger, right? So when there is any movement that is coming in terms of money that is coming to the business as part of the capital that we have, since it's coming from the owner and capital account stand for the owners, that's going to be an item that is coming from the owner. And if it's coming from the owner, it's supposed to be credited because he's the one giving. He's giving to the business. So the business is going to receive it, and then you are going to what? I mean, the business is going to receive it, and then the owner is going to what? Give it out. Right? So that is an aspect when it comes to the capital. So that means that that capital is coming into the business because the owner is the one giving it out. And the owner account stands for capital, and they are going to credit what? That capital account because it's coming from the owner. So we credit that capital account. It's an incoming item, and the capital will credit it. Additional capital, whatever it is, we credit it in that way round. When it comes to revenue, the same thing. Let's say we have engaged in what? Sales. We have traded our goods. We have sold some of our goods to our customers. What is happening here? When they pay for that amount, right? When they pay for that amount, we are receiving the cash into our account, right? But since that stock that we sold was a result of sales, it was going out, and it's part of the sales we have made for the period. What do? Since an incoming item, we made the sales. Even though we made the sales and we received something from our customer, which was a result of cash, it's part of an incoming item, right? And supposed to be what? Credited. So all what? Revenue or sales that counts or income that counts as in the form of an incoming item supposed to be what? Credited. And lastly, when it comes to the liability, whether a current liability or the non-current liability, it's an incoming item supposed to be what? Credited. What is the incoming item here? For instance, let's say we receive goods from our suppliers on credit terms. We haven't paid for them, right? We haven't paid for that goods or that service. It's still on credit terms. So what is happening here is that we are receiving all the stock, which will be part of our assets. But that occasion was as a result of a process of getting stock that is coming into the business. But because we have not paid for it, it becomes a debt. And it results in what? A liability. It results in a liability because it was an incoming item from our suppliers into the business. So that idea of that will makes it an incoming item, and under liability, we are saying that all incoming items are supposed to be credited. So that is the idea when it comes to what? The capital, revenue, and then liability. Whether a short-term liability or a long-term liability, whether a current liability or a non-current liability. So far as an income, you're supposed to credit it.